You can't control what the future holds, but you can take control of your investments with principle. Whether your goal is to enjoy a comfortable retirement or to secure your financial legacy for future generations. After all, your future and aspirations are worth investing in. That's why we offer a wide range of fund options that gives you global and local exposure for better returns. With more than 142 years of global investment experience at your fingertips, you can take full advantage of opportunities to build your wealth. And we make it easier for you to manage your investments with our enhanced digital solutions. Now you can easily buy, redeem and switch your investments at your own convenience with our easy-to-use online investment portal. Never miss the right opportunities to invest with cash or iInvest. As you build your legacy and aspirations, we will be by your side to help you secure the future for you and your loved ones. Start taking control of your investments with principle today.
Assalamualaikum and a very good evening, everyone. Thanks for joining us. I am Titina Dazari, your moderator for tonight's webinar topic, Fixed Income, a Smarter Choice for Investment today. Okay, so our featured speaker for this evening, Mr. Tay J. Yao, Portfolio Manager for Fixed Income Principal Malaysia. I will now invite Jay to provide a brief introduction about himself. Over to you, Jay.
Hi there. Hi, everyone. So first of all, thank you very much for attending our webinar. And also thanks to John and Nadia for inviting me for this event. It's always a pleasure to be here. So just a brief introduction on myself. I started my career in the investment banking within the debt capital markets department. And I was involved in the structuring and the origination of bonds, mainly for our corporate clients. And I was there for about 3 years before I moved on into the asset management industry as a credit analyst, where over there I covered mainly the power sector and also had the chance to cover various industries like ports, toll roads, industrial sectors. And then from there, I transitioned into the portfolio management role. That was in 2020. And I started off with the deposits and the money market funds before moving on to managing some of the longer duration portfolios, which includes the bond fund, which we will share a little bit more details later. Right. So back to you, Nadia. Yeah.
Okay, thanks, Jay. Now, before we begin, I would like to share a couple of house rules. Okay, this webinar will take approximately 30 minutes with a 15-minute Q&A session after that. If you have any questions for Jay, please do drop them in the comment section. We will pick the questions with the most likes, yeah? Okay, without further ado, I'll invite Jay to begin his presentation.
Yep. So let me begin with the review of how the market has actually performed over the last few years and up to April of this year, right? So as you all know, looking at the slides over here, 2020 was the year where the COVID-19 pandemic ravaged the world, and that actually led to a global recession. And despite this, you can see that both equities and fixed income have actually performed strongly in 2020, right? And that was mainly because central banks globally loosened their monetary policies. And with the fiscal stimulus that's also provided by the government, like cash handouts, right, to aid the affected groups. So as you can see here, despite that recession, equities actually strongly performed. You can see the S&P 500 performing by about 16.3%. And you can also see like bonds performing very strongly as well, 9.2% in 2020, right? And of course, because the most of the economies globally were pretty much in a restricted mode, you can see Brent crude oil actually declining quite substantially by 21% in 2020. And of course, inflation wasn't a problem yet during this time, mainly because, again, most of these economies globally remain pretty much restricted and activities were pretty much subdued. And just to highlight again, in terms of monetary policies, the Fed actually cut the Fed funds rate by about 150 basis points, all the way to bringing the lower bound of the Fed funds range to 0%. And they also expanded their balance sheet from 4 trillion to 9 trillion, mainly to buy bonds and support the market. And for Malaysia, locally, we have the OPR actually cut by 150 bips. So Bank Negara actually cut initially in January from 3.25 to 3%. And then after, when most of the economies went through a lockdown from March 2020 up to July 2020, Bank Negara actually cut by an additional 125 bits to bring it to a record low of 1.75%. So now moving on to 2021, this was the year where vaccines actually made a breakthrough, and there was gradual reopening of the economies worldwide. And of course, with all the stimulus and all the loose monetary policies, this eventually led to commodities rebounding strongly, where you can see Brent oil actually rebounded by 50% and copper rallying by about 27%. And I think during this period, inflation was starting to slowly creep up, but the markets were still cheering, right? As the Fed back then, they reiterated that the inflation trend was only transitory, and they would continue to maintain these loose monetary policies. So because of that, bonds actually suffered in 2021 because, as you can see in the bonds over here, Bloomberg Barclays Global Aggregate Index, that's declined by about 4.7%. And that's mainly because, real yields were actually turning negative, where inflations were going up, but Fed was just maintaining its loose monetary policy. So that affected bonds. And in 2022, where inflation looks to be a little bit out of control, where you see in the US it hit multi-decades high, and the Fed slowly, they begin to acknowledge that inflation was no longer transitory. So inflation was very high last year, mainly because, if you recall, it was affected both on the supply side and the demand side. Supply side was mainly because of the Russian-Ukraine war. And also, if you recall, China also had lockdowns, which pretty much affected the global supply chains. And the demand side, of course, was still the pent-up demand being unleashed following the reopenings and also from the loose fiscal and monetary policies. So this actually led the Fed and other central banks to pretty much tighten their monetary policies aggressively last year to combat inflation. So last year, the Fed actually increased its Fed funds rate by about 425 basis points. And Malaysia raised the OPR by 100 basis points to 2.75% by the end of last year. So as a result of that, we can see both equities and fixed income suffering in 2022. And I just want to highlight also for Malaysian bonds, which we will show later, we have been a bit more resilient, mainly thanks to the relatively controlled inflation over here, thanks to our subsidies on oil and the price control on food items. And this actually resulted in Malaysian bonds not suffering as badly in last year. And bringing us all the way to this year, up to April, markets have generally performed quite well, where we saw inflation trend actually peaking last year and is continuing to move downwards. And that actually led to markets potentially pricing in for central banks to end their tightening in their monetary policies, right? So there was, of course, some concerns earlier, I think sometime in March, where we saw the banking drama both in the US and Europe, and also some concerns on the US debt ceiling, which actually caused fears of a potential recession and this year in the US, and that actually led to some softness in risk assets. But lately, we have seen the risk-on mode again, as we saw some the negotiations on the debt ceiling to be making some progress. and the recessionary odds have been revised lower, which explains the rebound of risk assets of late. So that leads me to my next slide, which is basically how has Malaysian bonds actually fared, right, during this period, right? If you look over the last few years, right, where you can see Malaysian bonds have actually been quite resilient and they've actually outperformed quite well over here, right? You can see especially, I just want to point your attention to 2021 and 2022, where you can really see how well Malaysian bonds have performed. You can see the Malaysian bonds are represented by the gray bars. The blue bars is the Bloomberg Barclays Global Aggregate Bond Index, right? And we have the orange bar, which is the Asia Credit Bond Index, and the yellow bar is your KLCI, right? So looking at 2021 and 2022, Malaysian bonds have outperformed in the way where you see in 2021, it has only declined by 0.8% as compared to all your other asset class comparatively here. And in 2022, that's the even more stark difference where you can see Malaysian bonds, despite all other asset classes, if you recall last year, it was very bad, where most of them were pretty much in a negative territory, but Malaysian bonds still managed to record 1.5% positive return. And up to date in April, you can see it over the gray bar here, we have returned so far by about 3.8%. And now what we have done over here at the right-hand side of the chart here, we can see that if you were to compound your returns, right, over the last 5 years and up to April, right, you can see that Malaysian bonds have returned by about 26.3%. This is opposed to your KLCI, which has actually lost by 21% over the same period, right? So this basically shows why Malaysian bonds should be considered by investors in your asset allocation as a form of diversification, and also considering its strong performance over the last few years, right? And next slide, please. Okay, and this slide pretty much shows a breakdown of the performance for the year to date of April, right? You can see pretty much this year, Malaysian bonds have actually done quite well compared to 2022. So if you recall earlier where I mentioned Malaysian bonds have returned 3.8% year to date, you can see it over at the year to date column, where you can see the BPAM Bond All Index. And if you were to look into more granularity, you can see that long bonds have actually outperformed, where you can see in the numbers that are highlighted in green, the long duration bond index, the government bond index, actually returned 5.25% up to April, right? And this was because, again, inflation has been pretty much on a downward trend, and that has probably put less pressures on central banks globally to tighten their numbers. In fact, some of them are potentially pricing in a rate cut, right? Because of the scares that we saw in the banking sectors in US and Europe. And of course, Malaysian markets also did well when Bank Negara actually surprised the market in January by pausing the OPR at 2.75%. That actually led to a rally in the first 4 months of the year. But of course, we had Bank Negara raising the rate to 3% in May, which I will talk about later on. And also, of course, we had the strong buying in the local market, which was mainly driven by reinvestment demand from the local government bond maturities in the month of April. Can I turn to the next slide, please? Okay, so the question from here is, where do we go from here, right? So if you can see from this chart, you can see that US banks have been tightening their lending standards, as represented by the blue line, right? And that pretty much leads to weaker commercial and industrial loans growth going forward. So there was also this senior loan officer opinion survey, which we have been also tracking, where this pretty much confirms this trend, where we saw US commercial banks actually tightening their lending standards, right, across all businesses and nearly all of the business and the household loan categories. And part of the reason for this, where lenders actually tighten it, is because they cited deterioration in credit quality and collateral values, and also a reduction in their risk tolerance. And if you look into the survey as well, it also pointed to weaker demand for loans from borrowers due to the high borrowing costs, right? So if you look at the US BBB rated corporates 10-year borrowing rate, it has actually spiked from 2.2 to 3% back in 2020 to 2021 to 5 to 6% today. So that's a large spike in your borrowing rates, right? So that's why the demand for loans is actually getting weaker, right? So of course, all of this is pointing to weaker loans growth ahead, and this actually leads to a virtuous cycle, right? So you have weaker loans growth, and then from there you have lower credit creation in the economy, which will eventually lead to weaker activities and earnings, and risk off in markets, and also leading to a weaker hiring and wages. So overall, it's pointing to a much weaker and softer outlook for the US. Next slide, please. And over here, we have the Conference Board leading economic indicator, which we also track. So I think this is a leading indicator where you can see that every time this blue line on the top here, every time it turns south, it goes below 0, it's always almost always followed by a recession or a very sharp contraction in your US real GDP, right? So that you can see it, the gray shaded area is pretty much where a recession pretty much happens, right? So you can see that in 2001, 2008, 2009, and 2020, those recessions are always, you can almost always see the leading economic indicator always turning south before those recessions. So right now, guess what? Look at the latest numbers on 2023, right? You can see it's turning south quite aggressively, very sharply, right? And in fact, these numbers were updated up to March, and we have the latest numbers, which were also came out in April, and it continued to fall again by about 0.6% month on month. So it's a 13th straight month of decline, and yeah, definitely it's not looking too good overall in the US. Next slide, please. And over here, in terms of inflation projections, we can see that the US inflation also appears to continue with its downward trend. So recall last year, it hit about 9%, right? Sometime in the middle of last year. And the latest headline numbers that came in, it actually came in below 5% at 4.9% in April. And if we were to project the numbers going into sometime in the mid part of this year, we expect these numbers to actually fall towards the low to mid 3% by the third quarter. And next slide, please. So now with regards to the Fed policy rates. So the latest, of course, we had the Fed actually hiking the Fed funds range by another 25 basis points, bringing it to 5 to 5.25%. And I think this was pretty much expected by the market. But if you look at the FOMC statement, they did sort of signal that this increase may actually mark the end of their tightening cycle. And in fact, a few days ago also, Powell also actually highlighted that the stresses in the banking sector could also mean that these policy rate by the Fed may actually not need to rise as much if they were to achieve their goals, right? Basically to bring down inflation. So what we have over here, you can see the blue line is where the FOMC members, the median numbers of where they expect the policy rates to be. So they're pretty much expecting policy rates to remain steady pretty much throughout the remaining parts of this year, right? And if you look at the dotted lines, where the dashed lines, where you can see both in gray and green, those are what the market pretty much expects where the Fed funds rate to be, right? So pretty much you can see over here, the market is expecting the Fed to cut rates quite aggressively in the early part of May. I think that was mainly because of the concerns on the banking sector and the US debt ceiling drama, which led them to price in aggressive rate cuts by up to 100 basis points come early 2024, right? And we think that, of course, the Fed is likely to stay paused for now at the current range, as we think that, you know, the job market still remain tight and the core inflation is still running far above the Fed projections of 3.6%, right? So right now we think that the Fed is likely to stay paused for now. And in fact, you can see the markets have actually shifted up their rate cut expectations. You can see the red arrow is moving up, and they are now expecting a cut of up to 50 basis points by the early part of next year. And that's also mainly because, you know, we have seen some progress on the debt ceiling negotiations, and market has pretty much pat down their bets of a sharp recession. So the movements over the last 2 weeks has actually caused the US Treasuries to actually bear flatten. And we saw the US Treasury 10 years actually moving up by 35 basis points to 3.72%, right? Okay, next slide, please. Now, locally, we have Malaysia actually raising the OPR to 3% in early May, right? So part of the reason for this hike to 3% is mainly because so sorry, let me recap back. Okay, so remember in January they actually paused the rate at 2.75%. Market was actually expecting them to increase the rate to 3%, but in fact they paused. And the reason for that pause is because they actually highlighted that they want to observe the impact of the 100 basis point tightening in 2022, where they increased the OPR from 1.75% to 2.75%. They wanted to observe the impact of this on basically on our domestic demand and our private consumption, right? So it's quite clear that our first quarter was pretty strong. If you recall, we beat expectations with a GDP growth of about 5.6%. And you know, so despite Bank Negara, you know, raising quite aggressively last year by 100 basis points, the domestic demand and the private consumption still remain very strong. So that's where Bank Negara actually came in to and decide that, you know, they need to increase the OPR by another 25 basis points to 3%. And not to mention that the core inflation numbers for the month of the last core inflation print was actually at 3.8%. So that was still quite high, though it's coming down. The trend is still coming down, but yeah, Bank Negara actually took that opportunity to actually increase that rate to 3% in early May. So overall, I think from Bank Negara's statement, they remain quite neutral on our growth. They mentioned that risk to our growth actually remains quite fairly balanced, where the upside risk actually comes potentially from a stronger tourism activity, and also the implementation of projects, including from those retabled in the budget 2023. And the downside risk will come from weaker than expected global growth and also more volatile global financial market conditions. Next slide, please. And here, where do we think the OPR will go from here, right? So right now, our base case is for Bank Negara to actually pause the OPR at 3% for the remaining part of this year. So part of that reason is because inflation is actually trending downwards, right? And this actually puts less pressure for Bank Negara to further tighten their monetary policy. So while we think the core inflation may still remain high in the near term, especially, you know, we just got past the Ramadan period, and we expect it to actually trend lower towards the end of the year, towards the low to mid 3%, as represented on the chart on the right. And We may see some slight uptick if the government reduces the electricity subsidies for the T20 in the second half. There's not much details at the moment, but overall, we still expect the inflation to trend downwards over the remaining part of the year. And the chart on the right, the yellow bars are where we expect the core inflation to be. Your black line, it's your OPR rate, and the green line is pretty much your real interest rate, which is your real interest rate is basically your OPR rate minus your core inflation, right? So of course, when real rates are negative, that's what we experienced pretty much last year, where inflation was high, but your OPR was still low. So your borrowing rate is low and your inflation is high. It actually spurs people to take on more borrowings, and spend those money because things are going up quite fast, right? So right now with inflation potentially trending downwards, as represented by the yellow bars, which is actually moving downwards, your real inflation is actually expected to, your real interest rates are actually expected to go up. And I think Bank Negara is also seeing this. So right now, they have actually adjusted in their monetary statement. They actually mentioned that their monetary stance has actually been adjusted from accommodative to slightly accommodative, right? And right now, also would Bank Negara consider moving towards a more restrictive area? So even if BNM were to hike, right, we think at most, there would be another one more 25 basis points hike. But right now, our base case is for OPR to still remain at 3%. So we think the current stance right now remains just nice, right? Especially in light of the softening external environment, and especially with the weak Malaysian export numbers that came out recently. And also, if you look at China's recovery, it does seem to be weaker than expected. So right now, I think it's just a nice level to be at right now at the 3%. Next slide, please. Next slide. Okay, so overall here, I just wanted to show you how foreign holdings have actually been up for ringgit bond markets. It's actually up by the fourth consecutive month, and it's actually up by about 1.54 billion in the month of April. And year to date, they've actually bought up about close to 13 billion ringgit of Malaysian bonds. And most of the inflows were actually into our MGS market, which is the Malaysian government bond markets, and the Islamic counterpart, which is the MGII, right? Next slide, please. And over here, we can see the breakdown of the Malaysian government bond market, who are the holders. And this data is updated up to December. We only have the data up to December. And I think what is really interesting over here is the rise in the holdings in EPF, as you can see in the green triangle. And following the end of those EPF withdrawals, EPF actually has been coming back to the market to basically buy up our MGS and also the GII. So that is a technical positive because that shows some support in our market. Next slide, please. Okay, and over here we have the retabled budget 2023, right, where Anwar actually presented in February. He presented the retabled one. If you recall, back in October last year, where Tengku Zafar was the previous MOF, right? So when he presented that time in October, he was expecting the budget deficit for Malaysia to be at 5.5% for 2023. But when Anwar presented it, he actually managed to bring that target down. So this is actually an improvement, right? So it's from minus 5.5% to -5%, right? And can you turn to the next slide, please? Yeah. So basically, that number of -5.5% to -5% is actually an improvement. So that is definitely a positive, right? And in fact, the government is actually targeting to further improve this deficit number to -3.2% by 2025, right? And of course, this is it's a positive factor, which will be monitored by your international rating agencies like S&P, Fitch, and Moody's, right? So with that fiscal consolidation, it would be rating positive for Malaysia, and that also for Malaysia in terms of your reduction in your fiscal deficit for 2023. That also means that your supply for bonds in the market would also be slightly lower. So previously, because of the previous target of -5.5% and the expected deficit of 99 billion that was presented by Zafro, where then Anwar actually managed to present a better budget where we saw that deficit numbers coming down to 94 billion, right? And -5% deficit. So with that lower deficit numbers, we actually expect the government to issue less bonds into the market. So of course, with that, that means actually lesser supply as compared to before. And that would be a technical positive for our markets, right? And also in the budget, the growth forecast for this year is expected to be at 4.5%, and inflation forecast remains to be quite stable, between 2.8 to 3.8%, right? So overall, it does look to be quite a positive budget over here. Next slide, please. And this slide over here shows how Malaysian high-grade bonds, basically corporate bonds, they have tapped into the market. So investment-grade bonds are anything that ranges from your AAA to your AA, single A, and your triple Bs, right? And the one that we monitor quite closely, it's the ones over here where we see the AA2 curve, where the average rating for a principal lifetime bond fund, it's the average rating is at around a AA2. So if you look at the AA2, this is just a generic one, where you can see that the yield is close to about the mid 4%, right? In terms of your yield to maturity. And if you look at the green bars down there, those are your credit spreads. Credit spreads are basically the yield of the corporate bond less the yield of the government bond of the same tenor, right? So ideally, you want when you buy a bond, of course, buying a bond with a higher credit spread just means that you're buying the bond relatively cheap, right? You want a higher spread in general because it's offering cheaper, but of course that also comes with a higher risk, right? So the thing to show over here is that credit spreads have already widened, right? Quite a bit from 2022, right? You can see they were quite tight sometime in the mid of 2022, and that has actually widened. So that means that that they're a lot more attractive as compared to last year. And so credit spreads, you may be wondering, yes, if we are expecting a recession, or especially in the external side, right, in the US and the developed markets, right, wouldn't that actually cause credit spreads to widen? Yes, but we do see that the move actually tends to be lower for investment grade bonds as compared to the riskier high yielding bonds, right? Because the reason for this is because these high grade bonds, they are generally these companies are actually more resilient. They are more defensive and of higher quality, so they wouldn't widen as much, right, as compared to some of the higher yielding and riskier bonds, right? And just to share a bit in terms of our credit outlook as well, right? So I think overall, despite the higher interest rate environment and the expected slowdown in the global economy, we think that Malaysian credits in our markets, they are well placed to withstand the rising interest rate and the global slowdown because of their relatively strong balance sheet. And while we do expect some margin erosion, right, we think it will be quite contained as compared to the previous 2 years. I think if you look at the Malaysian corporates, they actually had a more challenging time during those lockdown in 2020 and 2021. So now that we have gone past that, I think they've pretty much gone past that bottom, and the worst part is sort of over. So it's definitely better going forward, especially if we expect Malaysia to not fall into recession despite a potential one in the US. And overall, the outlook does seem quite sanguine at the moment. Next slide, please. And this is the last table over here. Just wanted to show the returns over the last 15 years for bonds, right? So on the left-hand side of the table, we have the government bonds, the performance of the government bonds. And on the right-hand side, we have the corporates, right? Corporate bonds, right? So you can see, if we just pay our attention to the last 15 years, because the last 3 years, you can see those numbers are not great, as you know, because everywhere else has been suffering pretty much in terms of bond performance, right? But like highlighted earlier, Malaysian bonds have been quite resilient relative to your global and your Asia bonds, right? So our local ringgit bonds, if you look at the last 15 years, on average, if you were to look at their compounded annual growth, right, in terms of their returns, right, they have managed to generate an average of 3.89% for your government bonds on average over the last 15 years. And if you look at your corporate bonds, they have managed to generate 4.89%, right, on average for the last 15 years. And if you were to look deeper into those, you can see that long duration bonds, as represented by your 7-year over. Look at the 7-year over, which is on the right-hand side of the column, right, of each table. You can see that over the last 15 years, long duration government bonds have actually, on average, performed by about 4.5% per year over the last 15 years. And it's even stronger if you look at the corporates, where the long duration corporate bonds actually perform by about 5.62% per year over the last 15 years. So again, just want to highlight, that bonds, they can generate strong performance, and those numbers can also be quite resilient, right? No matter what kind of environment that you're in, if you were to hold them in the long term. Next slide, please. So just to highlight again on the summary, just to sum up. So the sentiment for bonds will likely remain positive, given that the outlook in the developed markets does seem to be quite weak at the moment. We are definitely facing a slowing economic environment. And given the defensive nature of bonds in general, it will perform well, right, in this kind of environment. And like I highlighted earlier, the inflation numbers for Malaysia, we do expect the headline and the core inflation numbers to actually trend lower up to end of the year. And that may actually lead Bank Negara to potentially hold the OPR at 3%. And in terms of our fiscal deficit, it has improved, right? Last year, we recorded an actual number of 5.6% fiscal deficit, and Anwar now has targeting a 5% fiscal deficit of GDP in 2023, and he plans to bring it down to 3.2% by 2025. So overall, that is a good fiscal consolidation plan that he has to further improve the government finances, which will then translate into potentially better rating for Malaysia, and also not necessarily a better rating, but at least a better overall credit profile for Malaysia, and that could improve the sentiment on our local bonds, right? So overall, we still prefer to position ourselves in high quality corporate bonds. We are selective and defensive, acknowledging that the overall external environment has weakened, and that's why we want to position ourselves in corporate bonds which are of high quality, right? And we do have two funds over in principle, which we would like to share, which includes the Principal Lifetime Bond Fund and the Principal Islamic Lifetime Sukuk Fund, which are able to consistently pay consistent dividend payout every quarter. Next slide, please. Yep. So just to highlight some of the key characteristics of our Principal Lifetime Bond Fund. So this fund would actually suit investors who are able to hold over the medium term to the long term, and where they want a diversified portfolio of bonds, right? And to also receive regular income, right? Over pretty much every quarter, we do pay out dividends. And the fund is invested about 70 to 98% of its NAV in bonds. And we also have some limits to also invest in unrated bonds. And over the next slide, we can see the performance and the overall risk of the portfolio. So as you can see here, over for this the data is up to end of April, where year to date the fund has actually performed returned about 2.92%, and over the last 1 year it has returned 6.44%. That is a pretty commendable return, given how last year has been quite challenging for the overall markets, right? And if you look at the bottom over there, we have the quarterly distributions, where on an annualized basis, it's we aim to pay out about close to 4% annualized on every quarter, right? So as at end of April, the overall yield of the portfolio is about 4.72% with a duration of about 4.7 years. Next slide, please. And this pretty much shows the overall fund composition, where you can see how the portfolio is structured within the respective time bucket, credit rating, and the industry compositions. Next slide, please. We also have the Islamic counterpart of the fund. This is managed by my colleague. So it's pretty much it's a similar fund, but it's just structured where it's according to Sharia compliant, right? Sharia compliance, right? So it's the same, or it's mainly to be invested in Sharia compliant bonds, and will be suitable for investors who have a medium to long term horizon, right? And next slide, please. As you can see over here, the fund has also returned quite strongly by 2.91%, but in year-to-date April, and over the last 1 year, it has returned 6.04%, right? And yield to maturity of the fund is at 4.42% at the end of April, with a duration of 4.84 years. And likewise, over the next slide, you can see the overall fund profile with the time bucket, credit rating, and the industry compositions. Yep. And that pretty much sums up my presentation, John and Nadia. Yeah.
Okay, thank you, Jay, for sharing this insightful presentation. We still have a bit of time for one or two questions, so please continue to submit your questions to Jay in the comment section below. Before we begin the Q&A, we would like to share with you our current offer. While volatility and the sting of short-term losses might leave you feeling anxious, it can be tempting to change how you invest in hopes of a better return. Diversify your investments via fixed income assets. Invest a minimum of 2,000 ringgit and above to get up to 0.68% reward. Use the offer code Invest Your Wealth when you make an investment via our online investment portal. Offer ends 31st July 2023. And you can visit our website for more information. Okay, so I will read to you, Jay, the first question. So the question is, will inflation turn upward in second half? If yes, will OPR to be revised accordingly?
Hi, okay, thank you for the question. So inflation, like I presented earlier, I think overall our expectation is for inflation to generally trend downwards. But that being said, I think we also have there's some expectations that the government will reduce the subsidies, right? Especially for your electricity tariffs. And I think they also intend to reduce the subsidies for diesel, and eventually going forward, depending on how successful they are with that diesel plan, they will also then move on into the RON 95, right? But I think for this year, we don't expect the diesel and the RON 95 plan subsidies to be removed just yet. I think potentially for the remaining part of this year, the government could potentially reduce the subsidies for the electricity tariffs, mainly for the T20 households. I think there are not much details that are released just yet, but I think that might potentially lead to a slight uptick in inflation, overall inflation. But that is mainly for again for the T20 households, and that's why for the remaining 80% of the population, they would pretty much still enjoy that electricity tariff rebates that's currently offered by the government. With regards to next year, the government is still exploring on how they want to remove the subsidies for that diesel, and that is probably for next year. And from there, again, they will see how they would then implement it into your RON 95. Yep. Does that answer your question? Yeah.
Okay, thank you, Jay. Okay, I think this is a linked question. So it's they say, of all the bond funds, which one would you recommend and why? Also, please share the duration, YTM, credit rating profile as well. Plus, if there's any problematic issues in the portfolio.
Okay, so again, can you turn back to the slide again on the overall fund profile, where we can see the YTM and the overall duration? So we have two flagship funds, basically the Principal Lifetime Bond Fund and this Principal Islamic Lifetime Sukuk Fund, right? Sorry, can you go back to the bond fund, Lifetime Bond Fund? Okay. Yeah, one more slide up. So this one is the Lifetime Bond Fund, which allows us to invest both in conventional and Islamic securities. So there's definitely more flexibility where you can invest into some of the conventional names, right? And these include names like, for example, like a Genting. You know, it's technically like a non-Sharia compliant, right? And because of that, sometimes the yields are higher, and that's why this fund would be able to participate in those names. Where right now at the end of April, yield to maturity, it's about 4.72%, duration of about 4.7 years, right? If for those investors who want to find Sharia compliant investments, then we have that Principal Islamic Lifetime Sukuk. But by nature of that, you will not be able to participate in some of these conventional bonds, which may be able to offer a higher yield. But can we turn to the profile of the lifetime Islamic Sukuk to share the, so the yield to maturity of this Islamic fund is 4.42% with a duration of 4.84 years. Yep.
Okay, one last question for you, Jay. It is hold on. Do you hold Country Garden paper?
No, we don't have any Country Garden exposure within these two funds. And I think, well, one thing I also would like to share, right? So Country Garden is in the real estate, and I think there's quite some interest on the real estate sector given the higher interest rates, right? So if you see our funds in our two funds, I think we have quite a sizable exposure in real estate, right? So of course there's some concerns, right, where there's a direct link where house buyers or house purchasers would be directly affected by higher interest rates, and that could affect their purchasing ability, right, which would then translate into a weaker overall credit for your property players, right, for their ability to sell in the future. So, but that being said, overall we still think that this sector remains quite stable, and the sector sales activities still remain quite robust, right? And we don't expect any significant downside to the property sector. But that being said, we definitely have a strong preference for property credits which have established sales record and a strong balance sheet. So for countries like Country Garden, we definitely don't have that name because we are quite cautious on the developments, especially in China, with regards to the property sector over there. And we are generally quite cautious, and we have so far avoided this name for the portfolios. Yeah.
Okay, Jay, one final question. What is the different bond offer by bank and principal?
Sorry, by banks? What do you mean by that? Sorry.
The difference between the bonds offered by banks, and what are the difference between the bonds offered by bank and principal, what we are offering? Yeah.
Okay, I'm not too sure when you mean the bonds that are offered by banks. Does that mean the bonds, individual bonds that are offered by the private banking to their clients, or what? So perhaps we can follow up with this question.
Yes. Can
yeah.
the person who sent the question clarify what do you mean by the question? I think there's I think it's okay, Jay. I think the person is no longer with us. Okay. I think that can conclude our webinar session for today. Thank you so much, Jay, and everyone for joining. Until next time, goodbye.
Okay, thank you very much, everyone. Bye.